Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of Paris rapeseed, Winnipeg canola, and Malaysian palm oil markets. I'll start with Paris rapeseed. There are two key patterns here to consider. The first and larger one is the February/April to July ascending broadening wedge pattern, currently 705.25 to 746.5. This is not a perfect pattern, but it has been the main driver higher through to the early part of this year. The break lower has the following incredible targets, so we have broken lower through it, and they are incredible. The primary target X is in the 352 even area, with a harder to get secondary target X1 in the 217 area. These are obviously pretty much out there targets that you put into your diary in the back page and just look at it maybe once a year or until I remind you. And the second, smaller pattern is currently in development and seems a more reasonable opportunity. It is created from the break lower of the larger pattern in June and July and is an optimized falling wedge pattern, currently 595.5 to 656.25. The two key recent features here are the halt on the decline at the February low of 599.75 and the break of the 50% Fibonacci line of December 20 to April 2022 move at 644 even, plus the retesting of this 50% Fibonacci line this week as resistance. And an effective way it capped the market, suggesting perhaps this falling wedge is the way to look for the future. The key problem with this pattern is it is in the wrong place. By that I mean it should be forming after it had an ascending pattern, not as in this case a great big gapping drop lower. This leads me to suspect that perhaps this pattern may morph further along its lifetime into something else. However, until that happens, this is what the market looks like right now. Winnipeg canola. Whilst the September 2021 low at 839.20 and the August 2021 low at 817 even, both acted to halt the declines back in late June and early July. It was the 50% Fibonacci line of the October 2020 to April 2022 move at 863.80 that triggered the retro reverse engines on the way down. And it is this week also capping the rise. The market over July formed a double bottom, but it has failed to see that pattern exploited, and for that reason I've decided for now to not place any primary or secondary targets on the upside. However, what has become evident since the start of the sideways to slightly lower movement we have seen in recent days is that there is a bear channel, currently 784.20 to 896.80, a bear channel in operation, and it is this that is driving the current market lower. I say that because 2 weeks ago we had a dead cross of the medium moving average, currently 988.20, moved down through the long moving average, currently 1007.90, and this caused the combined indecisive spinning top and outside day 2 Fridays ago and the subsequent drop. Now, here's the important piece. Such a dead cross ought to have pushed prices significantly lower, much lower than what we saw last week. Thus, we can read into that the current bearish channel is the main driver lower. Not anything special, just this current small bearish channel. And until that breaks or morphs into another pattern, then it will continue to show the slightly bearish angle of attack. One final thing to look out for. The short medium moving average, currently 878.30, is rapidly approaching from above. When that impinges on the market, well, that could be the next event to watch for. Bursa Malaysia crude palm oil. I'd like you to take special note of the bearish halfway hesitation back in late June. The leg down that ran into July was coincidental and likely triggered by the first dead cross we'd seen here for quite a while. It was of the short medium moving average, currently 43.45, down through the medium moving average, currently 53.75. The move down was halted, I have to assume halted, as there was nothing else nearby. It was halted by the extension of the neckline, currently at 38.09, of the September 2015 to November 2017 head and shoulders pattern. Since then, prices have started a small bull channel higher, verging on being an ascending expanding wedge pattern, and that's currently between 39.66 and 47.19. Now, three things to note. Firstly, remember that dead cross I mentioned earlier? Well, last week we had a dead cross as well, one I would regard as a more significant. It was the medium moving average, currently 53.75, down through the declining long moving average, currently 54.92. So, did that dead cross provoke a similar bearish action? Well, no, not really. Interestingly, the short moving average, currently at 41.38, provided a sort of dynamic uptrend support. Hence, the bearish influence is either departed, abated perhaps, and maybe not as, and obviously not as strong as late June. Secondly, the short medium moving average is thundering lower and likely to impact the market next week. I'll be very interested to see the result of any impact, as should the market push up through it, then it will further aid the idea that the bearish incentive is at least dormant, if not completely still. Finally, as I've already said, we have a bull channel since July. However, should we regard this bull channel as just on its own or part of a larger pattern? Is it part of a larger May to date bearish halfway hesitation pattern is what I'd like you to consider. Now, it is too early to say, but it's worth looking at as an idea. I'll keep you apprised on this idea. Thank you for listening. This weekly broadcast gives essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyrights Eddie Tofpik and ADM Investor Services International Limited. And here comes the final bit.